Supply and demand trading is without a doubt one of the best ways to do technical analysis. If you can understand supply and demand, you'll be able to take some brilliant positions. So in this video, I'm going to teach you pretty much everything that you need to know about supply and demand so that you can start getting insane results. If you understand the concept of supply and demand, you will have everything you need to carry out profitable technical analysis. I'm going to give you absolutely everything that you need to know from my 8 years of experience. So the first thing you need to know is that markets are driven by buying and selling. The whole reason that markets move is because traders are buying and selling assets from one another. More importantly, it's the institutional traders. So in a market, we have two types of participants. Institutions like commercial banks, hedge funds, central banks, and retail like me and you, individual traders. But us retail traders only make up a very small percentage of the overall trading volume. So it's the institutional traders that actually move the market. So when these institutional traders are buying, we see the markets move up. And when they're selling, we see the markets move down. And this happens because of supply and demand. If there is high demand for an asset, the supply gets bought up. And then the prices go up because the people that hold the asset can demand more for the transaction. So if there's high demand for an asset, markets will move up. When there's low demand for an asset, markets will move down. Now to explain this in a simple form, let's say I've got 10 gold coins and no one wants them. No one's interested in buying my 10 gold coins. At this point, I'm going to have to sell them pretty cheap because otherwise I won't sell them. But let's say suddenly something in the market changes and now these gold coins are in high demand. Well, people will want to buy them off me as fast as possible, which means if I want to, I can up the price and people will still pay for it. And every time one of these gold coins gets purchased and is taken off the market, the prices can go up even more because the supply falls. So high demand means low supply, and this equates to high prices. Now imagine someone else comes over with 100 more gold coins. Now they're not so rare, so people might not be so interested in buying them. The supply is increased, the demand might fall, therefore prices would fall. That is the basic theory of supply and demand. And this is pretty much exactly what we see in the market. Now, supply and demand zones are plotted on as consolidation areas before large upward or downward movements. And a demand is simply a discounted price to buy from, while a supply is seen as a premium price to sell at. So to explain that quickly, if you bought something for $100 and suddenly it was $150, you might see $100 as a bargain. So if the market gets back down to that discounted $100 mark, you might buy more. The same with the premium price. Imagine the price of that $100 purchase got to $200. Well, that's a premium. You might want to sell there because you've doubled your money. If the market dips, but then comes back to that level, it will be seen as a premium, so you may want to sell again. And this is exactly the kind of thing we see in the market and how we aim to trade supply and demand. When a market pulls back to a demand zone, we want to buy, and when the market pulls up to a supply zone, we want to sell. As I've just stated, supply and demand is visualized as zones on a chart, specifically consolidation areas before large up or down moves. But there's a specific way to plot them. We'll get into real chart examples, but here it is. So the common way to mark out supply and demand zones is to use the last down candle before the up move for a demand zone, or the last up candle before a down move for a supply zone. Now, I personally don't follow this methodology. I simply hadn't really heard about this, and I worked out my own way to do it, which I find works better for me. And that is to use the last candle before the impulse. So an impulse is a large, strong movement, either up or down in a market. In this instance, obviously, we are seeing the market as bullish, the market is pushing up, so we have this bullish impulse. Now, the last candle before the impulse is always going to be some form of indecision candle with wicks either side and a smaller sideways ranging body. Now, if we consider what this candle is actually showing us, this is where the significant buying has taken place, because this is the final point before the market exploded to the upside. So by using this as our demand zone, we're focusing on the prime area where the mass buying really took place. Now, realistically, you can choose whichever one of these methods you like, backtest them if you want, but this is how I do it, the last candle before the impulse. Now I'm going to show you what it looks like and how we can plot these zones on the charts. So in this example, we have this large bearish impulsive movement, and above that we have this sideways candle, this indecision candle. So an indecision candle is defined as such because it's showing indecision. It's not showing clear control from buyers or from sellers. This candle here has got a large wick above and a large wick below, which means that buyers attempted to go higher, sellers attempted to go lower, but really it closes a pretty indecisive candle. Compare that to this one here, where we have a huge selling push with little to no wicks. You can see that clearly the sellers are in control. So this candle here at the top is where institutional selling entered the market, which makes this a supply zone. So we're using that last candle before the impulse. This is the final point of which the sellers took control of the market, and this is where those major sell orders were being placed. So the concept now would be that because this was seen as a premium price to sell from in the past, if the market is able to get back up into this zone, we would be likely to see another push from sellers. If you'd sold your assets up here at a high price and you had some more, or you wanted to short sell the market, well, if it gets back up to here again, you see this as a premium, you'd be happy to get back in or get back out, depending whether you're looking to sell more contracts or get out of your existing position. So if we play this market forward, you see the market trades up, comes into this area of supply without breaking the high of the zone, and then we have a push to the downside, which would lead us into a new sell trade opportunity. Now, supply zones are always selling zones. So supply is always the consolidation before a large downward move, and we always only want to sell from these areas. Demand would be the opposite. So if we were in an uptrend, in this example, instead of a downtrend, this consolidation before the upward move would be a demand zone. And then the focus would be on buying once the market came into this level. When we're trading with the concept of supply and demand, we need to make sure we're always in line with the trend. So let's discuss that just now. So in this example, we can see the market is trending to the upside. We've got this low, we have a lower high, we have a lower low, but then we shift into higher highs. Now, because the market has shifted into a higher high, we would anticipate a new higher low to form and a continuation then into new higher highs as we see this market form. If the market is forming and printing higher highs and higher lows, we must only be buying demand. We must pretty much completely ignore any supply zones. Now, we can use supply zones for targets, but we absolutely shouldn't be looking to sell from supply zones because we're going to get beat down a lot of the time. So you can see that pretty much everywhere in the market, we are going to see some form of supply and demand zones. So there's supply zone there, supply zone there. We even get supply zones in these smaller movements, like we get one here. We're also going to get one here within this trend. But you can see that overall, because we're in an uptrend, these are rarely actually going to hold up and work really well. So what we want to do is if the market's printing higher highs and higher lows, we only want to focus on buying demand. Okay, so we would buy this demand zone and we would buy this demand zone too, but we would absolutely not sell from the supply zones because the market's trending up. So we would be going against the trend. So we only buy demand in uptrends, supply is not in our focus, and we would only sell supply in downtrends. So if we flip the script here and we have a market that's forming lower lows and lower highs, we would only be looking to sell from supply, and we would instead ignore all of the demand zones that form within any of these trending movements, okay? We wouldn't be interested in buying this demand because it's not going to take us into new considerable highs. It's just likely to end up in a loss. We always need to consider market efficiency and imbalances when trading supply and demand concepts. Here's what I mean. Now, when it comes to validating your supply and demand zones, there's also one more thing you need to be aware of. Obviously, we want to trade them with the trend, but we also need to consider market imbalances. So take a look at these two examples and you'll see they look very similar. Except on this left example, we have a large wick, which is traded into the demand area and then pushed away. On the right, we don't have that wick. So this price range here, the impulsive candle, becomes an imbalance, okay? So in the first example, we have no imbalance because the market has been retested, the demand has been retested before the market pushed away, meaning there's no open price range or gap left open. On the right, we see the open price range is left open and the demand zone hasn't been retested at all. This means that this is a valid demand zone and this is one we would buy from. So we never want to buy from demand zones that have already been retested. They're only good one time, but we do want to buy from demand zones that haven't been retested yet. If we have an open imbalanced demand, that will be a point that we want to buy from. Remember that tip because it's very important for making sure you don't buy from redundant zones. So now let's go to a real chart and I'll show you how we can mark up supply and demand in line with the trending structure and the efficiency and imbalances that we've discussed, and how we can use supply and demand for entries and for targets on the positions that we take. So now we're looking at this 4-hour price action on GBP USD. And we can see a market that has just shifted from lower lows and lower highs into a higher high with a break of structure at this level. So with the market now breaking into new highs, we know this trend is bullish, which means we only want to buy. We should not be looking for selling opportunities here which means we are going to be focused on demand, not supply. So within this bearish movement, for example, we've got a supply zone just here. Would we want to focus on selling the supply? Absolutely not. We've got another supply just here. But would we be interested in selling this one? Also no. And the reason why is because this market is clearly bullish. So selling supply is actually pushing against the trend, going against the direction of this market. So what we would want to do instead is buy from demand. Now there's a few areas of demand in this trend that we would want to keep in mind. The first one really is going to be around this area just here. So we can see when we had this break of structure, this was one of the candles that actually kicked off this break. And there is some imbalance into this level, which can be visible just around this area here. Now, would we buy from this area? Realistically, no. And the reason for that is because we've also got deeper imbalance down into the extreme. Now, the extreme zone is simply a name we give to a zone that is the furthest away from price. So in this price movement from this low up to this high, the extreme is going to be the lowest zone. Okay, in that area, it's going to be this consolidation point. So down here, we can see we had consolidation before a large impulsive movement up. Now, this is a little bit trickier to mark the demand on, but I'll show you a simple tip now. The last candle before the impulse here is going to be this indecision candle, okay? From the high to the low, it is that candle there. Now, because we have this large wick extending out of that, what we can do is actually just extend the demand down to cover this low as well, which means our demand zone would be this area here. We do that because we know as long as the market doesn't push beneath this low, we should be viable and valid to go into a new trending movement. So because we have the imbalance that we've mentioned just previously, this is going to be an area we're interested in buying from. We're not interested in buying from any of these other demand zones higher up because there's no imbalance. Every single time we get a demand, we get a push away, a pullback, and a retest. Okay, there is no imbalance until we reach this point here. Yes, there's a small imbalance there, but there's also deeper imbalance at the extreme, which makes this the higher likelihood position for us to take. So now what we would want to do is wait for the market to pull down into this area of demand, and then we would look for our buying opportunity. Let's move on to another opportunity as to where we are right now then. We can see here that we had the low, lower high, lower low, lower high, higher high, and then we've had this higher low form, which has been validated with this break of structure. So just here, we've had a new break, which has pushed us into, yet again, another phase of upside price action. This push drove us into this area of supply. But do we want to trade this supply? No, because the market, as of right now, is bullish. So we will be continuing to look for buying opportunities using supply and demand concepts. In this instance, it's going to be demand. So let's move in and focus on this area of price action then. With where we are right now, where would be the optimal buying zone for an opportunity or for a trade to be taken? Well, it's not going to be this demand at the extreme, because this demand at the extreme has already been retested just here. It's also not going to be that following demand, because that following demand has been retested with a wick there, there, and there. And yet again, it's not going to be this indecision candle before the large impulse away, because this has been retested here. Even if we were to refine this candle down to this one, this has also been retested with a tap into the zone just there. So there is no imbalance anywhere lower down than pretty much this point just here. But we can see that this demand is imbalance, okay? We've got this large push away, and this has left an imbalance open, which is likely to be filled. So because the imbalance is open, the probability of that becoming a viable point to buy from has gone up a pretty significant amount. So what we would want to now do is mark on the last candle before the impulse, which is going to be this doji candle that we've got marked out. That is going to be our demand zone. And now if we weigh up all the factors we've discussed so far, we've got a demand zone with an open imbalance, we have a clear uptrend, and we have no imbalance anywhere lower down in the movement, which makes this a high probability point to take buys from. So if we wanted to get into this market, we would be placing our buy here, stop under the zone, and then we would target higher. So now let's discuss using supply and demand for entries and for targets. Well, the first thing is, of course, when we are buying from demand, we want to use buy limits. Very, very simple way to trade. We can place our buy limit on the demand zone, and we can have stops under the demand zone. Now, for me, I generally like to have my stop losses under the next significant point of structure, just because it makes it a little bit safer. So if we consider the structure here, we've got this higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then we have this higher low into a new high. So realistically, this area just here is going to be our next significant structural point. So if we put our stop losses under this higher low, that means we are pretty much safe even if the market decides to wick through a little bit and trade just underneath the demand, because that is sometimes going to happen. So this would be my preferable trade. Stop loss is a little bit on the larger side. We are on the 4-hour time frame. You could go with a tighter one like this. That is going to improve the risk reward a fair amount, but it will also mean you will lose a few more trades. So it's just about balancing win rates versus risk reward. Now, supply and demand can also be used in the conflicting way to find targets. So what we would do is actually identify a supply zone over to the left in the trend that could be seen as a viable level for the market to reach into. Now, in this example, we've already retested the supply that we just discussed here. So this supply is out of the question. We're not interested in seeing the market trade into that. There is then no open supply zones until we reach this point just here. But here we've got a pretty clear, pretty viable supply area with imbalance. So the imbalance is going to be in this open price move here, which means this is a reasonably high probability area for the market to reach into. So our trade could look like this. Now we've used demand pro-trend with the concept of imbalance to find our entry for our trade. And we've actually then just gone and used supply conflicting against the trend as our target, because we know if the market's bullish, it's going to continue trading up. And if it continues trading up, it's going to continue to do that until imbalances have been filled and supply zones have been retested. So this is going to act as really a magnet for price to be drawn towards before any meaningful reversal takes place. So if we're looking for buys, we can use that magnet point for our trade targets and for our profit taking. So here's a great example now of supply and demand used for number 1, trade entries, and number 2, trade targets. As you can see, by allowing that trade to play out as we just did, we saw the market come in, retest this demand area, and then we had a significant push in momentum coming in just here. The bullish momentum is clearly indicated by these wicks, which show rejections of selling pressure and new strength from buyers. We can then see that the market pushed up and didn't just push to this high, but it actually extended all the way through into that supply zone that we just used for our targets. You can see, as we said, these are magnet areas for price, and markets are unlikely to reverse significantly until they reach areas of significant supply or demand. So for a buy trade, even though we're not looking to sell supply, we can still use it as a clear target because it's the next meaningful point for any reversal to potentially come underway. So this is our target. This is our entry. We've went with the safer conservative stop on this point, and that brought us a 5.47% return for 1% risk in a very simple supply and demand setup. Now, there's one important thing you need to understand, and that is the concept of inducement, or how to approach multiple zones. So we can see here that having had this break of structure at this level, the market's now shifted into an uptrend. We are looking to buy. Now we've got 2 zones to pick from, and in the previous example, just before we ran over that, I said the reason that we would want to focus on this zone, the lower zone over this one, is because there is still imbalance left open into this area here. Now this concept that I'm discussing, I'm going to give you a bit more clarity on now, and it's this concept that makes this top zone an inducement zone. So basically, inducement is a bit of a trap. It's an area in the market that looks like a good place to buy or sell from, but will realistically generally land you in a loss. So this area here is an inducement because some traders are going to see this and think, all right, this is a demand zone, I'll buy from this zone. But there's actually reason that the market is going to be magnetized lower. Now, part of that is the imbalance that we've already covered into this area of consolidation in the low, but there's another aspect to this as well, and it's going to be liquidity. So to talk through liquidity, the first thing you need to know is that the liquidity in question sits here, okay, this line. This is what we call equal low liquidity. Now, the reason it's equal lows is, as you can see, we've got 1, 2, 3 equal lows, okay? Now, when we see this, this is seen also as a support, right? Support and resistance conflicts with supply and demand in a few different ways. This is one of them. So with the support floor, traders will be looking to buy the market once it retests this level again. So if the market came down and hit this level, traders would then look to buy from that point. Now, because we know there's going to be a significant number of retail buys there, there's going to be a significant number of retail stop losses, underneath that level. Okay, general education suggests when you buy a support, you put your stop loss under the low. Now, this area of orders, this area of liquidity causes a problem for buyers. Because we have this huge amount of liquidity, this huge amount of orders, and the markets react to orders, it's unlikely then that we're going to react from this point and get a new solid movement to the upside. It's a lot more likely that the market will be drawn through into the area where the orders are situated to then react from the orders when the transactions are taking place. So this area here at the top, the one we first discussed, this is an inducement area because there's not real massive reasons for the market to react from this point. There's still liquidity in the market, meaning these equal lows. There's still orders and transactions to be filled underneath those equal lows. And then of course, there's still the imbalance into the demand zone. The demand zone, obviously, as we know, is the area where significant buying has taken place before. So it's seen as the discount price level for the market to react from again. We know that traders like this price area for buying. If the market gets into here, that's where significant buying is going to take place again. It's not particularly going to take place from the equal low liquidity. It's not going to take place from the imbalance. It's going to be from the demand. So we're looking for the market to at least trade into this area of demand for a new push to the upside to take place, which means we can ignore this area up here, which we would classify as the inducement zone. So that's the inducement. This is the true zone, and this is the zone that we want to take our buys from, not the higher area. This same theory of inducement can be used and seen a lot of times in the market, and I just want to make sure that you're aware of it so that you can be trading from the high probability points like this one and not getting caught up buying or selling from inducement zones. Now, there is a brilliant way that you can use supply and demand to get better entries and improve the risk versus reward of the positions you take, which can double or triple your profits. And that is refining zones. For this example, we're just going to target the highs because I really just want to draw focus to the entry. Here we would get a 7.07%, or just call it 7.05% return on this trade. That is awesome. Very, very good stuff. If we went for the more conservative entry, clearing that recent low, we're looking at a 4.5% potential from this trade at 1% risk, which is also incredible. However, we can refine the zone to improve the risk reward more. So this here is the 4-hour demand, okay? This is a 4-hour chart that we're looking at, and this is a 4-hour indecision candle. If we go to the hourly, what we will now see is within that 4-hour doji, we've got deeper imbalance. And that brings us into this area just here, this smaller indecision candle, the last candle before the impulse. So now we've got new imbalance just there, which means that this 4-hour zone can be refined down to a smaller 1-hour zone. And you'll see that this 1-hour zone is actually about half the size. So if we were to bring the entry down to the 1-hour point where we get in, leaving the stop loss exactly the same, still clearing that recent low, if we then go to the 4-hour time frame, you'll see that we've just extended this profit target from 4.56% to 6.85%. So we've added nearly another 2% onto this trade without actually having to do anything except for tightening the entry. And remember that 7.07% or 7.05% more aggressive trade, well, that's now going to be double. We could get 14% out of this trade simply by refining the zone. Because what we've done is half the size of the entry, we can half the size of the stop loss, and by halving the stop loss, it means we can use double the position size without risking any more dollars, okay? So we could risk $100 here, instead of $100 over a larger amount by doubling the position size, which means the risk reward we're going to get out of it, we're going to make double the profits on the movement just with that small refinement. So that right there is the biggest trick that you can use to improve your risk versus reward, simply refining zones to a time frame relevant position. Now, I want to mention that is important as well. See here, we went from the 4-hour to the hourly. We only want to be jumping like that. We don't want to go from the 4-hour to the 5-minute. That's over refining. That will lead you to miss trades. But you could go from the daily to the 4-hour, or from the 4-hour to the hourly, or from the hourly to the 13-minute, and so on and so on. And that is how you can maximize the profits on your trades, just like this one. So that's pretty much everything I wanted to cover in this class. I hope you've enjoyed it. If you have, check out this class next, or click the link in the description to check out my free course, which is going to teach you how to build a trading system for yourself. Thank you for watching, and I'll see you in the next video.